This is ERC Group 1 group presentation for Nationwide Insurance. In 1925, the company that would become Nationwide was founded as the Farm Bureau Mutual Automobile Insurance Company. Their original purpose was to sell auto insurance to Ohio farmers. In 1926, the company sold their first policy, signaling the beginning of Nationwide. Throughout the late 1920s, the Farm Bureau expanded into states other than Ohio, including West Virginia, Delaware, and North Carolina. They continued to write only auto policies. Farm Bureau began to expand their coverage outside of auto policies. In 1933, they began offering fire and property insurance through Farm Bureau Mutual Fire Insurance Company and acquired American Insurance Union to add life insurance to their products. The Farm Bureau continued their expansion into other states. In 1943, they offered their services in 12 states, including Washington, D.C. In order to reflect their new goals and continued expansions, Farm Bureau changed their name to Nationwide Insurance, the moniker they are still known by today. In 1925, they truly became Nationwide, offering services in 32 states. Nationwide continued to expand their services, eventually becoming the fourth largest insurance company in the nation. In 1982 through 1985 was the beginning of the Western Development Project. As the name states, this project was intended to expand Nationwide's presence into the western United States. Nationwide purchased an existing insurance company in 1985 by the name of Wasu. This purchase helped establish Nationwide in the West and the ability to provide property casualty insurance in the West along with it. This expansion had Nationwide enter into new territory of underwriting commercial businesses. During 1985 to 1990, a period of retrenchment was occurring. During the later half of the 80s, a series of product liability claims showed that their new venture into commercial properties were underpriced for their risk. This led them to momentarily cease their growth. In the 1990s, Nationwide sold off their communication division to further focus on their insurance, their core business of insurance. In 1997, Nationwide became a publicly traded company. This allowed them to have a strong capital base, but at the same time, they had to change certain accounting standards, such as GAAP standards as opposed to their original standards, and also kind of public reporting that includes with a publicly traded company. In 1998, Nationwide acquired Allied Group of companies, and they were able to leverage this purchase to diversify their geographic presence and improve distribution channels. Beginning in the 90s, Nationwide sought to transform itself into a global financial leader, and acquired life insurance operations in Luxembourg, Poland, Thailand, and Brazil. Due to the complexities and costs of being in the insurance industry, it makes sense that as the number of individuals being covered by an insurance policy increases, the overall cost that a company incurs by managing and paying out decreases as well. This is why the application of economies of scale and scope is a positive for the insurance industry, as it shows how the companies can spread risk from a few individuals to a large amount, but at the same time decrease the cost of doing business for both itself and its customers. In its basic definition, economies of scale is described as factors that cause the average cost of producing something to fall as the volume of its output increases. Although smaller insurers may be able to obtain some of Nationwide's customers based on geographic or personal choices, economies of scale will prevent large companies from losing a large amount of its market share to smaller companies. These smaller insurance companies that do offer lower prices for insurance policies would not be profitable in the long run if a catastrophic event occurs, as they would not have enough capital on hand to cover the losses that would have occurred. On the other hand, since Nationwide is one of the larger insurance companies within our country, the company would be able to provide the necessary capital needed when the insureds began putting in their claims from the catastrophe. What this means is that although the smaller companies might be able to survive as a business during the short term, their long-term survival is in question. Enterprise risk management allows companies the opportunity to use risk to their advantage instead of viewing it as a threat. Diversification is an option firms can use when trying to implement risk as a benefit into its company. Let's use Nationwide as an example of how diversification could be used with economies of scale and scope for the company's benefit. As I said before from the previous slide, both economies of scale allow an insurer the ability to pool a large amount of individuals together, which lowers both risk and actual losses. However, even though this type of diversification is effective, firms can even go further than that in order to ensure that losses they pay out and the revenues they receive do not fluctuate by large amounts every business year. Whether an insurance company is private or a public entity, large fluctuations in earnings from year to year are never viewed in the business world as a positive occurrence. In order to accomplish this task, Nationwide could look to incorporate policies that either positively or negatively correlate with the total risk of the firm. By doing this, the company could introduce new products into markets that were previously not associated with the company, which could potentially help the company hedge itself against downfalls with the rest of its insurance portfolio. Enterprise risk management is a very important concept for businesses to grasp, and diversification is an important step within this process that companies such as Nationwide should consider using. However effective, diversification is the key. Here as there is a high risk involved when using hedging techniques to protect your company portfolio. Nationwide saw a great business opportunity to align its business operating structure with the objective of getting more in tune with the commercial business side of the insurance industry. In order to accomplish this mission, the company acquired WASU, which was thought of at the time to be a successful acquisition. This was an important step for the growth of the company as it signaled that they were finally trying to become more than just a personal insurance company. However, after a period of time, Nationwide finally decided to divest itself from WASU. At the time of Nationwide's acquisition of WASU, the market conditions were fair as the company decided that it needed to engage expansion into what the top executives from the case labeled as Western development. Not only that, but the internal process that the company had in place were telling them that WASU and its operations were financially and strategically a good fit for the company. However, Nationwide based the decision on not using an enterprise risk management approach, which is why, in my opinion, WASU was divested only after a short time. For example, WASU experienced large unexpected losses from a mixed liability claims that commercial market declined soon after the acquisition was complete. The case also identified that WASU's reserve deficiency was a lot worse than Nationwide initially expected, which signaled that the company did not have the proper internal controls in place to manage risk like enterprise risk management does. Not only was there a lack of due diligence internally and numerous external factors such as liability claims that played a role in the downfall of WASU, but the creation of Nationwide Financial Services also played a part in the situation. During the late 80s and early 90s, Nationwide insurance business was growing rapidly, while at the same time WASU was struggling. As a result of this, the company launched NFS as a publicly traded company and eventually became a major source of capital for the company, and it began to change how the company operated. For example, the organizational culture of Nationwide was changing to more of a publicly owned company with audited financial statements and other common public company processes became the success NFS experience. Because of the success NFS experience, this led to the company adopting a new vision for the future where they focused on the risk-return relationship as a little more than they previously had. This new operating strategy was one of the main reasons why WASU and Nationwide parted ways as the company was just not valued as much to Nationwide using its strategic vision. The move from privately held mutual insurer to publicly traded company brought on many changes for Nationwide. From basic accounting and reporting rules to the basic company culture, privately held firms in general are created and managed in order to cater to specific needs of a small number of owners, which inherently makes them different from a publicly held company. Mutual insurers specifically are run for the express purpose of providing insurance coverage to their owners, their policyholders. This arrangement means that the only interest of the firm is to ensure sufficient diversification and raising of capital to cover any claims that may arise. No additional risk need be undertaken, as this ownership structure is not an investment per se. Regulatory and reporting hurdles are lower for this type of firm as well, and basic statutory accounting is utilized. Publicly traded firms must appeal to a much broader base of potential owners, so return on investment must be provided. It makes growth and the general acquisition of capital base major focuses of the firm. Diversification becomes not just a risk mitigation strategy, but a growth strategy as well. As the appetite for risk is increased in line with the expectation of investment return, GAAP, SOX, and other regulatory and reporting principles also come into play, adding management burden and cost. Nationwide restructured its asset allocations in the 2000s in a move from an individual investment decision approach to a new mentality applying big-picture portfolio management principles. This approach focused on risk optimization versus simply risk reduction, focusing on risk versus return and capital intensity of endeavors. This effort was clearly focused on bringing about growth for investors as well. Part of the asset allocation must inherently focus on matching assets to liabilities, because failing to do so brings about a host of risk. A company could easily become unable to meet payout needs if assets were not liquid enough to cover claims, or if liabilities and assets were so closely correlated that assets were significantly reduced at the same time liabilities rose. And assets that were too capital intensive could tie up so much capital that they hindered growth and other strong investment opportunities. These types of risks were what led the company to divest their asset management business and to reduce their exposure to Atlantic hurricane risks in Florida. It will mean constant focus in the future on measures like required economic capital that measure capital intensity, as well as simulation models predict impacts of catastrophes on both assets and liabilities. Nationwide remains dedicated to continually improving its enterprise risk management strategy. In the words of their CEO, we must ensure we foster a culture of continuous risk management improvement to avoid past missteps and sustain a competitive advantage in taking and managing risk. A few recent events highlight Nationwide's ERM strategy. Only a few weeks ago, Nationwide announced that they would not be offering coverage for any fracking-related risk. They acknowledged that their personal and commercial insurance policies were not designed to provide fracking coverage, and they do not have a comfort level with the unique risk associated with the fracking process to provide coverage at a reasonable price. Nationwide also recently launched a new mutual fund to help investors manage overall portfolio risk with just one fund. The Nationwide Alternatives Allocation Fund invests in several different asset classes that have different return patterns than the stock and bond markets. These assets include global real estate, emerging market debt, emerging market stocks, commodities, treasury inflation-protected securities, international bonds, and high-yield bonds. Nationwide is using their ERM knowledge to offer an easy way for investors to build a well-diversified portfolio. In an effort to become a global financial services leader, Nationwide purchased Gartmore in March of 2000 for $1.6 billion. Gartmore specialized in equity growth and held $86 billion of assets under management. It had operations in Germany and Japan and a strong brand name in the UK. The purpose was an attempt to diversify Nationwide portfolio, as less than 2% of Gartmore's assets were located in the U.S. The acquisition of Gartmore was the avenue under Nationwide's strategy for the company to enter the international asset management industry. Nationwide acquired Gartmore just 2 months after the technology bubble. With hindsight being 2020, Nationwide certainly would have considered other factors making their decision to purchase Gartmore. First, they had little experience with international asset management. The company should have looked more domestic sources for revenue growth. Also, Gartmore was a very large company with 4 times the amount of assets of Villanova Capital. Villanova was the arm of Nationwide responsible for managing the business. Nationwide would have been wise to seek smaller, more manageable acquisition opportunities. Strategy should have been aligned to support acquisition decisions. Villanova's stated growth plan was to buy smaller companies, yet Nationwide moved forward with the purchase of a much larger entity. Cultural issues also plagued the combined firms and led to the loss of key Gartmore fund managers. Nationwide should have recognized that business practices vary among firms, and an acquisition of an international company would certainly bring about cultural challenges. Nationwide failed to be understanding and proactive towards differences in corporate culture. Finally, Gartmore funds did not receive any advantage in Nationwide's Best of America product line selection process. If Nationwide had this to do all over again, they would have promoted, pushed, and provided shelf space to the funds with Gartmore provided. Looking back on the decision to purchase Gartmore, Nationwide likely would have not gone with the acquisition. Nationwide sold Gartmore in 2006, just 6 years after the company was acquired, thus completing Nationwide's exit from Europe. Nationwide had a very strong competitive position in the United States, and Nationwide's strength was on U.S.-based business. In Nationwide's attempt to diversify its portfolio, perhaps it should have considered just the U.S.-based asset of international firms. Nationwide's acquisition of Gartmore was poorly timed. Gartmore was at or near its peak in 2000. Nationwide may have been better off pursuing acquisition targets when the respective firm is not at its strongest. Management structure should be aligned prior to any acquisition to fully support and welcome the new venture. The importance of company-wide corporate culture should be embraced and carefully considered throughout the decision-making process. Management's complete understanding in this regard will go a long way to strengthen post-acquisition success. Nationwide's acquisition of Gartmore was very different from previously successful diversification attempts. Nationwide's previous acquisitions were smaller companies that were focused on different geographical regions of the United States. Gartmore was significantly larger than Nationwide's existing asset management business, and only 2% worth of Gartmore's assets under management were from the U.S. Some of the problems with this acquisition can be blamed on poor timing, since Nationwide purchased Gartmore only 2 months after the peak of the technology bubble. Management at Nationwide tried to take control of Gartmore's business even though they had little experience in European fund management. Nationwide has been successful in the U.S. and has a strong competitive position, but the Gartmore acquisition was a shift in a completely different direction, which proved to be unsuccessful. There are many different factors for management to consider when making diversification decisions. First, they need to decide whether internal or external diversification is best. Internal diversification is marketing existing products to new markets or marketing new products in existing markets. External diversification is when a firm looks outside of its current operations and buys access to new products or markets. It is also important to understand the cultural and regulatory differences if a firm chooses to expand into a new market, especially overseas. Finally, the rate and size of expansion must be realistic to avoid stretching the firm's human and financial resources. That is the end of our presentation on Nationwide Insurance.